Great. Thank you so much for the introduction, Mo, and welcome everybody to the Q3 IRU. For those of you just joining us, so I'm going to talk, Denise Chisholm is going to talk for about 20 to 25 minutes, and then we're going to transition over to Tim when I reintroduce him to talk about our active ETF strategies that you can also employ. So for those of you who've never attended an IRU before, what you are about to see is a lot of what we do internally at Fidelity. I am, as my day job, in equity research, and my job is to pitch company ideas, is to pitch ideas to our diversified portfolio managers. But I don't pitch individual companies. We have a whole fundamental staff that does that. I talk about sectors, factors, themes, the market backdrop, and I do it all in the context of historical analysis on macroeconomic and fundamental data. So that's why when Mo says our data-driven views, I really do lean heavily on the data. I think you can see historical relationships that help you understand signal relative to a lot of the noise in the market. And I do think that history really offers an ability to not sort of fall into what I would call market narrative pitfalls, things that you thought that were true that really just haven't been consistent in history. So with that, we're going to break it down. My part of the presentation, if we go to the next slide, Taryn. My part of the presentation will talk a little bit about performance. We're going to talk about the scorecard, what sectors I find interesting, what sectors I don't. And then we are going to get into my favorite part, which is the narrative associated with that data, and then how you can use that narrative and data to inform your own investment views. So with performance, we've had yet another good quarter in the S&P 500, over 10%. So now our one-year performance, again, in the S&P 500 has been just almost 30% over the course of the last year. What is interesting and notable is that in the last quarter and really over the last year, while technology has been absolute dominant leadership, the second sector up has actually been financials. And while that has been an inconsistent correlation historically, usually they have negative correlation between the two, I do think that this is a sustainable theme. I think that I am a pro-cyclical investor at this point. I do think the odds skew favorably into those cyclical sectors, and I'm going to include financials with that. But I don't think that you necessarily have to give up your growth names in technology to buy them. So with that, let's get into the scorecard on the next slide. So this is really my recommendations, which is based on the data. Now I give you the data in the scorecard to the right. So we have 4 fundamental factors, we have 4 valuation factors, and we use relative strength, which is just basically a proxy for momentum. We rate each of those 11 sectors all the way over to the left side of the column, from consumer services to all the way to utilities. We rate them each relative to themselves, relative to the S&P 500, and the top 3 get green pluses, and the bottom 3 get red minuses. Now, if you are wondering if that's just a quant signal that we mine and then translate to the strategist view, it's just not that simple historically. Sometimes valuation is a good thing, meaning you want to buy cheap stocks. Some sectors actually have a monotonic relationship. The cheaper they are, the more likely they are to outperform. Sometimes it's the opposite. When the stocks are expensive, earnings growth is usually a trough. So the expensive valuation is usually a good signal of a bottom in the market. That's actually what we're seeing in industrials right now. That's why the negative signal doesn't necessarily concern me as much. Sometimes there are signals that line up all against you. Fundamentals are negative, poor fundamentals in decline. Valuation is, again, more expensive than not. And relative strength has been a negative, meaning the group has been an underperformer, and a ball in motion might stay in motion. That's real estate. But I actually have a positive view on real estate because I think that they're not predictive enough at troughs. And a lot of the signals that I've already talked about in prior IRUs, and you can, if you want to look at the charts on real estate, you can go find it on my LinkedIn profile, where we see wide valuation spreads that I think already discount the fear of a recession. So with that as the data backdrop that doesn't always translate to my strategist view, let's talk about the strategist view. As I said, I think there are 2 ways you can skew as a sector investor. You can skew towards the defensive sectors, like consumer staples, utilities, the old telecommunication services, and to a lesser extent, healthcare. or you can skew anything else, which I would put all the other sectors under this umbrella, which is to say that they are economically sensitive. And I think, given that we saw a recession, I'm going to call it a recession, it's either a softish hard landing or a hard-ish soft landing in 2022. I think that we're still in the beginning stages of what could be multiple years of both a GDP and an earnings growth recovery. With that, I think that the risk reward is actually quite positive still for those economically sensitive sectors. So you see a green dot, which is a recommended overweight in consumer discretionary, financials, industrials, technology, and real estate. And you see red dots in those, what I'm going to call classically defensive sectors, which communication services is a little muddy now, but it is held down in my view of the old telecommunication services. So to the extent that you're interested in the cyclical component, I would rather you invest in technology stocks from a risk reward perspective. But also negative is energy, which I would say is a quasi defensive. Energy is kind of what got us into that recession. I'm going to call it a recession in 2022. It's not going to be what leads us out. And I think that the risk reward has shifted very negative in healthcare. We're going to talk more about that later in the presentation, and has shifted very negative for materials. I'm going to talk about that later on in the presentation. And utilities as well. So we are going to talk about in the call out slides more about what not to own. I feel like I gravitate each time. Some quarters I talk about what I want you to focus on as an investor, which we did last quarter, technology, financials, equal weighted consumer discretionary, small and mid caps. That's still the theme. Happy to take that in any questions. In terms of, I will try and be a little bit briefer than I am because I do want to get to your actual questions. We do try and answer as many of them as possible. But this time we're also going to focus on what not to own, which is going to be materials, healthcare, and utilities. So if you look at the overall market, we obviously have seen the market be very concentrated in terms of technology, but the green boxes are what I think is an average outperformance that I do think we are going to migrate to. On average, historically, 5 sectors outperform, 5 or 6 sectors underperform, and you actually don't just have one sector outperforming, which I don't think is a problem from a market signal perspective, but I do think that on a relative perspective, we will likely see the market broaden out. So with that, let's get into the content slides. The next slide. So from a macro perspective, I think I've talked about this in prior IRUs, but let's talk about it again. I just don't think we have a widespread inflation problem. Now, look, if you asked me to present the data on the fact that inflation is sticky, I would know what exact charts to give you. And in some ways, the probabilities to associate with those charts. The problem is that I don't find the data convincing. So the left-hand chart is the CPI, the core CPI, right? So I'm taking out food and energy, and then now I'm excluding shelter. So shelter in the CPI is about 40% of the weight. The PCE deflator, it's not quite as big. It's only 20% of the weight, 15 to 20%. So that's why in some ways the CPI usually runs hotter than the PCE deflator, which is what the Fed uses. So it's not just this, that we want to look at the CPI. We do want to think about that. But when you look at the massive deceleration we've seen, and it has been massive, for even core inflation, if you strip out the sector component, if you strip out the shelter component, over the last 8 months, we have been at or below target, which is 2%. So that most recent data point is 1.87%, right? This is what we're not talking about. This is everything outside shelter, right? And the diffusion index on the right-hand chart shows you largely the same thing. This is basically a diffusion index, how many are going up versus how many are going down. So this is the percentage of the CPI with price increases. And you will see it's at some of the lowest levels in history. So this inflation problem is not at all widespread. Now, the issue with shelter, if you've listened to a lot of strategists, sure, it's sticky. That is true. It has remained elevated this cycle. The problem with shelter is not that it's inaccurately calculated, right? There are different ways to calculate shelter. One is rental, the rents, and then an owner's equivalent rent. But both of those are problematic in the sense that we don't have the same problems associated with calculating the inflation rate for goods, because the marginal cost of the banana you buy is pretty much the same as the average cost of the banana you buy, because bananas basically last a week. Maybe they last longer in your house, but generally they don't really last that long. The problem with rents, or even owner's equivalent rents, is if I survey the most recent rents, that's not what everybody over the course of the last year has experienced, right? So you can end up with this big rent group that has 5 to 8% inflation, but the incremental rent, when it turns over, has zero. So what do we and the Federal Reserve know? That average is going to approximate to the incremental or the marginal rent. We just don't know how long and when, and that how long and when is going to be dependent on housing turnover, which has been fairly low. But because of this is exactly why the Fed, despite inflation being, quote, sticky or above target, can actually cut rates. Because most of what we're seeing in inflation is actually at or even below target. So with that, in summary on this slide, we don't have an inflation problem, which means we likely do not have a Federal Reserve problem, and they are potentially green lighted from a probability perspective to lower interest rates. And that is usually the sweet spot for equity markets. If you're a bond investor and saying Fed cuts are good for bonds, they are, historically speaking. But I will also say it's usually very tough. And by usually very, I mean 100% of the time historically, very tough for bonds to keep up with stocks when the Fed is cutting interest rates. So that's my view on inflation and how it relates to market trends. We go to the next slide. Let's talk about the recovery. I think that there is a lot of concern about the fact that it's been an abnormal recovery. I'm going to go back to that. Look, I'm going to call 2022 certainly a profits recession. GDP did contract on a year-on-year basis, although not much. And GDI actually did contract on a year-on-year basis in 2022. It just wasn't the sudden stop we had seen in the pandemic or the financial crisis before it. But when you look at the left chart, this is the year-on-year change of leading indicators versus the year-on-year change of stocks. And you'll see leading indicators contracted, and it had contracted before in most recessions, some non-recessionary instances, and our contraction wasn't a whole lot different than the contraction in leading indicators seen in 1970. That's why, for me, a lot of boxes got checked in 2022 as, sure, you can't call it a recession. I get it, because nobody lost their jobs. But jobs are a lagging indicator as it relates to the equity market. And that peak to trough contraction we saw in 2022 of 30% of the S&P, 40% of the NASDAQ, more in growth stocks, fulfilled what we usually see in a recession. So stocks discounted a recession that in some ways we didn't end up having. And now we've seen a recovery, left-hand chart again, in those leading indicators and a correlated recovery in stocks. To me, this looks very typical. There's kind of nothing to see here. Stocks have tracked fundamentals. The right-hand chart shows you the exact same with earnings growth. So the fundamentals have more than fulfilled what we saw in terms of the stock rally. So to me, I think that there are a lot of people still leaning on the fact that this is abnormal. And it is in some ways. Like, there are many things are abnormal about this cycle. And I have even said that it's off cycle this cycle. But when you really step back and say what matters for stocks, leading indicators, earnings growth, this looks like a typical recovery. And when you have seen a recovery like this, I didn't put all the charts there. Again, if you want to see all the charts behind this thesis, go to my LinkedIn, subscribe, you'll get the charts of the week in your inbox. What you find is it's usually durable. And by usually, I mean 80 to 90% of the time, you still have 10 to 15% average market returns over the course of the next year, which is above average. So again, we've seen a typical recovery. I would say that that's still a positive skew from a risk reward perspective for being overweight equities. Now, if we go to the next slide. Denise, you're always bullish. How can you use these things to think about when that will change? And that's true. So I do say, like, statistically, that Goldilocks has the highest odds. I know that we all want to debate a soft landing, hard landing. It's the Fed is engineering it. Personally, I think that there's more data to support the Fed following the cycle versus creating the cycle. Again, happy to take any questions on that. But in some ways, a lot of what I see is recessions are hard to come by. And by the way, so is inflation. But the risk reward does often change for stocks, right? So when stocks are cheap relative to bonds, that's very meaningful to me. When valuation spreads are very wide, that's very meaningful to me because I lean hard on these as what the stocks are discounting. So sometimes I focus less on the bad news and focus more on the discounting mechanism of the market because I think that skews your risk reward. I presented last time, and I don't think the slides are in here this time, that I'm still seeing that positive skew, meaning that I'll be the sort of contrarian in the room that says, I think stocks are discounting a much harder landing than most other people. But you can use that risk reward in the opposite way. We're just not there yet. So the OECD LEI on an absolute level is what you see to the left. So on an absolute level, we never got as low as we were in the 1970s or in any other recessions, right? But to me, it tripped a bottom quartile signal that usually means that you mean revert positive. We have mean reverted positive. We're about in the middle of the distribution. So what does the middle of the distribution mean historically? That's the right-hand chart. And there is a relationship here. The right-hand chart shows you the next 12 months of the total return for the S&P 500 once you've reached this middle quartile, meaning that you've recovered somewhat, but you haven't potentially recovered fully. Again, usually you have pretty good returns in US equities. Look, bottom quartile is the sweet spot. As equity market investors, you kind of want to be buying when everybody else is panicking, right? That's why I love these indicators, right? When it seems really bad, that's kind of when you want to be like poking up your ears and saying, wait, are there interesting opportunities? Is everybody already there yet? And this skew shows you exactly that. The worse leading indicators are, the more you should be interested in equities. The better leading indicators are top quartile, equities are all right, but you have a risk. It doesn't mean that they have to go down, but your risk reward is usually skewed below average. We may get there, we are not there yet. Those are the signals that I will be monitoring. So when I say we're in the early stages of what I think could be a multi-year cycle, these are the indicators that I'm watching. When do we get back to top quartile? When do credit spreads dip below 200 basis points? These are usually times that are consistent and correlated with risk rewards shifting more negative for equities. It's not how much equities go up. It's not how expensive equities are. That doesn't really help you. These signals tend to help you and be monotonic. So this is something you want to watch. We're just not there yet. Now, if you go to the next slide, I'm going to talk about the call outs in terms of healthcare, materials, and utilities, why I think the risk rewards are negative. So defensive sectors across the board are now statistically cheap. And by defense, I mean specifically healthcare, utilities, and consumer staples. So the left-hand chart shows you the relative forward PE. Again, we have the data. This is top 3,000 stocks going back to 1976. And we are now in the bottom half of the distribution in that sort of second quartile. And you will see, again, that skew that I'm always looking for, right? You want it to be linear. So the cheaper something is, the more alpha usually on a go-forward basis that the sector or individual stocks produce. And that's true. When it's expensive, you basically get zero relative performance. And when it's really cheap, you get 260 basis points, again, right-hand chart, of outperformance. Where we are does suggest outperformance. The question is, how strongly do you want to pound the table as an investor on that? To me, I skew to probabilities, not just average alpha. And to me, the odds are not perfectly predictive, right? 50-50, 54, and you can say 54 to 60. Look, that's not enough deviation to give me a good risk-adjusted return that I want to bet on. So, you come back and say, yes, the stocks are cheap, but that doesn't necessarily mean that now's the exact time to overweight. Even on average, that's true. The reason is, on the next slide, we go to the next, yeah. Things have changed. Right-hand chart, this is margins. So EBITDA margins, and you can see that they peaked in 1999 and have been falling since and have fallen aggressively over the last 18 months. Consumer staples doesn't look a whole lot different. Now, up until peak margins in 99, healthcare acted very, very differently. So the left-hand chart shows you the rolling correlation versus the market. And you'll see that on average from 1962 up until that margin peak of 1999, zero correlation. Healthcare was offense and defense. Since that margin peak, things have changed. There's been a very consistent X1 instance negative correlation with healthcare and the broader market, meaning if the market goes up, healthcare tends to underperform, and if the market goes down, healthcare tends to outperform. That's seen more easily on the next slide. If you look, again, left-hand chart, before 1999, if you knew the market was going to go down by 10%, you got 730 basis points of alpha out of the healthcare sector. This is where you wanted to be. And that downside protection basically hasn't changed since 1999, since margins peaked, nor has it changed in any 5-year increment since then. So healthcare is still consistent downside protection. If you knew the market was going to go down, this is a clear ballast in your portfolio. The problem has been the right-hand chart. Your cost of being wrong has gone up now. So before 99, before margins peaked, again, offense and defense, you knew the stock market was going to actually advance, you still have 100 basis points of alpha. You knew it was going to go down, 730 basis points of alpha. Boy, that's a no-brainer, right? That hasn't been true since margins peaked, right? Since fundamentals got worse, healthcare is not offense and defense. So while it still can be the ballast of the defense in your portfolio, to the extent that you get that wrong, the opportunity cost is now dramatically increased relative to history. And I think that that's what skews your risk reward negative from a perspective on healthcare. Now, if we go to the next slide, let's talk about utilities, which is every time. So I guess it was like a month ago now, I had, I think, 5 portfolio managers ask me about utilities. And at the time, it was when year to date, only technology and utilities were outperforming. And they said, is this a signal, Denise? Is this a signal that something is problematic? Meaning that if utilities are working along with tech, maybe it's sort of, reminiscent of the bubble, like where defense is working, and an ominous signal. And there's one thing that when I look at the data that's most interesting about utilities is that usually people ask you about it after they've outperformed, and usually that's a negative sell signal. So again, they've actually reversed course since then, but I think it's important for investors to keep in mind. So the left-hand chart shows you the relative outperformance of utilities through May. So that's where you got that year-to-date flush, and it was a top quartile relative performance. Utilities were down a lot, then they bounced. So what does that mean historically? The bigger the bounce, the more likely utilities stocks are to underperform over the next 12 months. So when utilities work, it's almost like the defensive rotation has already played out and you want to take the other side as an investor. This is true despite the fact that utilities are cheap and despite the fact that sometimes ROEs are actually improving. Now, this is not to say that there's no utility stocks to buy, and maybe we can get into a debate about whether some utility stocks are maybe part of the AI theme, and they are. But if you're a sector investor, or even a factor investor like low vol, or just buying XLU, I think that the risk reward is still negative. And the fact that the stocks outperformed is usually, what the meaning is usually, again, monotonically related, higher equity markets in the future, and underperformance in utility stocks. So again, this is yet another defensive sector that doesn't look like a positive risk reward to me. On the next slide, materials specifically, metals, and I said materials generally, metals and mining specifically. This has been sort of a green area for me. If you followed me on LinkedIn, you saw the downgrade come across, and I think that it's different this time is happening right now in CapEx. So mining companies, fortunately or unfortunately, have a long history of spending a lot of capital and destroying free cash flow. When you're in the top half of the distribution, and we just got there, CapEx relative to sales is now in the top half of the distribution, or in this case, bottom half of the distribution, high CapEx to sales. This has usually meant that free cash flow comes down and the stocks on average underperform. So this has been, look, it's been a little bit different this cycle where valuation was on your side for metals and mining specifically and materials generally for a long time. Earnings actually came down. Despite that, many of the stocks and individual subsectors within the sector actually outperformed. But now across the board, we are seeing that CapEx creep. They had the free cash flow. They're now spending the free cash flow. And shareholders usually don't reward you for that. So to me, the risk reward has now shifted negative for metals and mining companies generally, specifically, and then materials companies more generally. If we go to the next slide, things that, again, like I want you to keep from a framework perspective, I don't think inflation is a problem. That means I don't think that we have the Federal Reserve as a problem. I don't think the recovery is anything but normal to me in a lot of the ways that I look at it relative to stocks. And I don't think technology is a problem either. So Mike Goldstein, to the extent that you follow him, is a great quantitative researcher. He's done a lot of work on free cash flow for the Mag 7. But for technology overall, it is very, very different from what we saw in the bubble. In fact, on an earnings basis, you can say that PE on a forward basis is in the top quartile of its range, although just barely. But on a free cash flow perspective, we're still in the bottom half of the distribution. This is very different than what we saw in the bubble. Right, the ability to generate free cash flow for this sector and even the big stocks have kept them from being very expensive. And because they're not particularly expensive, you don't have this weird dislocation between where they are in terms of valuation and where they are in terms of fundamentals. So the real problem was in the technology bubble. When earnings growth is very strong, you can tend to mean revert, and there was no mean reversion priced in. But when you're in the bottom half of the distribution on free cash flow trends, even if earnings growth mean reverts, you might have already priced some of that in. So to me, I still see technology as a positive risk reward. Look, I don't think that it's likely to be table pounding market leadership, meaning the next 15% outperformance is likely to come from technology. I do see better areas right now, better areas that we talked about last time, like financials, equal weighted consumer discretionary, small caps, even real estate, interest rate sensitives within consumer discretionary, like home builders. But I don't necessarily think that that means that you have to eschew and get away from all of technology exposure. And if we go to the last slide, just because I get so many questions about valuation and value traps as it relates to international equities kind of look like healthcare to me. Yep, cheap for a reason. Right, so this is EFA on a median basis relative to the US on a median basis. The right-hand chart shows you that there's really not a lot of relationship with the relative valuation between the two and the odds of EFA outperforming. So if I start to scrape, and if I did this even through time, you'd get the same thing. If I start to scrape all bottom quartile instances, and whenever EFA raises its head and says, I'm cheap relative to the US, what are your odds that over the course of the next year, it actually beats the S&P 500? 27%. Now, why would that be is on our last slide, if we go to the next one, because the market is kind of smart. It knows that whenever EFA grows earnings faster than the US, it's usually not durable. There are a lot of ways to show what I could show on the left-hand chart and the right-hand chart. One way would be to think of, to plot GDP in the US relative to European GDP, which is a steady uptrend, meaning that on an economic perspective, the US just grows faster over time. On an earnings growth perspective, it gets a little trickier because we know the US grows faster, but it's mainly because of technology exposure. What I did on the left-hand chart gets away from technology exposure. It goes through the 11 GIC sectors, takes the median stock in EFA, compares it to the median stock in the US, and does that delta and says, and looks at when EFA grows faster than the US over time. And so looking back from the data to 1990, on average, even sector adjusted, median stock to median stock, materials company to materials company, financials company to financials company, EFA grows about 150 basis points slower than the US. And that's when the all instances, and you can see that it has gotten worse over time. To me, that's the definition of a risky value trap. Cheap for a reason. The market usually gets it right because the secular low in terms of earnings growth is going to be lower. The way I see the data playing out, which is we are still in the early to mid innings of an earnings growth recovery that still has further to go on margins, when Europe is still in a lagging position, I think the risk reward still skews favorably in odds of sustainable, durable US leadership in the equity market. So with that of the backdrop on, look, why still equities? Why still economically sensitive equities? I also wanted to bring Tim back on, because I think you're like a regular now, and talk about building blocks and our active ETF strategy. So I'm going to talk the theory. He's going to talk about how you can put that theory to work in the equity market. So thanks for coming back, Tim.
No problem. Thanks so much, Denise. I appreciate that. And thanks for everyone for having me today. I'm here and excited to talk about a new suite of products that we're offering here at Fidelity. And we like to call it our fundamental active ETFs. And I'm here to give you an overview, a little bit about what we're here to deliver. And What we really want to do is our value proposition is very simple. What we want, the goal is to leverage the incredible investment capabilities we have at Fidelity. There is an army of fundamental analysts here who are constantly turning over rocks and know everything, the insides and outsides of all the companies they follow. We have tremendous market strategists like Denise, who provide guidance on how to handle the current investment environment as well. And another thing, we're just not a fundamental shop. We also have a broad swath of quantitative analysts embedded with our portfolio management teams. And they provide stock selection guidance as well as portfolio construction guidance to our portfolio managers. And then obviously at the very end of the day, we have highly skilled and successful portfolio managers here at Fidelity who really synthesize all of that information and have delivered superior investment results for their clients. So really the goal of our fundamental suite is to source the highest conviction ideas from these successful portfolio managers into building block type portfolios that will remain consistent in their in their style characteristics and deliver long-term superior active returns over the course of a long holding horizon. So if we can go to the next slide, this is really the crux. These are the results of the investment performance here at Fidelity. So I'm going to take a second to really discuss what we're looking at here. And so in the top table, we have the percentage of peers beaten here at Fidelity from our actively managed portfolios. The top left shows the 3-year, the percentage of assets beating our peers. And you can see that it's been very consistent over the long horizon. And just shooting over to the right-hand side, you can see the continued success of our portfolio managers. And, in fact, the last data point there in the top right shows 78% of our assets have beaten our peers over the last 5 years. And this data is as of 6/30. And the graph on the bottom in blue is very similar, but it just shows the percentage of our funds that are actually in the top 2 quartiles of their Morningstar categories. As you can see, we have a lot of very successful funds here at Fidelity. And what we really do, our value proposition is to use the ideas from our these portfolios and package them into something that really remains consistent in its Morningstar category. And so can we move to the next slide, please? We'll give you a little bit an overview of the goal of our fundamental suite. And what we do here, we'll see this funnel here. We start with source managers. And one of the really unique aspects of this is a really strong partnership with our fundamental equity investing team, as well as I'm in what we call QRI, Quantitative Research and Investing. It's a really strong partnership between our quantitative research capabilities and portfolio management and our fundamental team. And so we work very closely with our equity chief investment officers to select a stable of source managers that we use for our portfolio as the basis for our portfolio and our ideas. The second part is once we have those portfolio managers selected, we've come up with an approach where we can actually put a rating on every single stock. And what we like to do is call that our conviction score. So obviously stocks that our portfolio managers like, if all of them like a particular holding, and it's their highest conviction idea, most likely this will be our highest conviction idea as well. And once we get all of our scores for all of the stocks across our source managers, we build our portfolio. And what we really do is make sure we have as much exposure to those high conviction ideas of our underlying source managers, while we make sure that we also have very similar sector composition as our managers, as well as our styles as well. So if our portfolio managers are on average overweight a particular sector, we like to be overweight that particular sector. And then finally, our implementation. These are fully transparent, active, not all of them. So we'll get into that detail in a minute, sorry. But our large cap active ETFs are fully transparent. And what we do is we rebalance these on a monthly basis to make sure that we're consistently refreshing our highest conviction ideas into the portfolios while maintaining our style consistency. So next slide, please. And so this just goes into a little bit more detail about things that we consider when we are actually selecting our portfolio managers. Like I said earlier, this is a very close collaboration with our chief investment officers who know their portfolio managers the best. They're the ones who are picking the portfolio managers to be on particular funds. You know, they also make sure that they stay within their investment guidelines and are ultimately responsible for their performance as well. And some of those attributes are style. So if we are a core portfolio, we have some S&P 500 benchmarked funds that might lean a little bit growthy. So what we will need to do here in order to create a core product is to select portfolio managers that may lean a little bit more to the value space. So style, footprint, and diversification are important aspects in this selection process. And lastly, in the suite that we have here, we have at least 6. We have here a minimum of 4, but in the suite that I'm going to talk about, we have at least 6 source managers in each style. And every month we review all of the different trades that we're going to that we do for the portfolios to make sure that they align with the way that the underlying source managers are behaving. And we also review all of our performance quarterly, along with all of the equity CIOs, as well as some other business partners. And we move on to the next slide. And so here this is really to give you an idea. If some of you are familiar with Fidelity products already, you may see some familiar names here on the bottom. And so we have, portfolios in the value space, the core space, and the growth space. And some of the names of portfolio managers that may, be common, very common to you, could be listed on the bottom. And so this is just a snippet of the PMs that we actually are using to help drive up the alpha in our portfolios. And like I mentioned earlier, we do have a close relationship with our chief investment officers, and there are also 2 quantitative portfolio managers that I work with in this process, Michael Kim and Michelle Horber. Go to the next slide, please. And so what do you mean by conviction score, Tim? Well, I hope that this graphic here is able to help explain. And on the left-hand side, what we're showing here is a plot of active weights for a particular portfolio manager. And the way that we think about conviction is the stock with the highest active weight should most likely be that portfolio manager's best idea. And so what we do in this case here is we rescale all of the positive active weights up to 100%. And then we plot each individual name along the x-axis, and that the individual active weights are plotted on the left. And if you added up all of those bars, what you would see is that curve on the right-hand side, which ends up at 100%. And what we're really trying to do is say, okay, this portfolio may have over 100 names, but which names do we actually really want to concentrate on, and which ones do we really want to buy in our portfolio? And what we do here is we try to highlight those by different colors. So greens being, the highest conviction ideas in a name versus blue, which is 3s, etc. And once we have something like this for every single source manager, what we can do is line them up across all of the different managers. And so the middle part of this slide shows how certain stocks actually rank in that 0 through 5 framework across the different set of managers. And at the very end, what we do is come up with a very simple 3-2-1 score where we want the highest conviction ideas to be ranked a 3, and we want to own as many as possible. And so if you take a look, you can tell that top stock here, stock number 1 in technology, it's a highly ranked stock across all of the different fund managers. So that's something we're definitely going to own in this particular case. And that's really the gist, really to boil it down on how we try to come up with high conviction scores. And at the end of the day, we really try to boil it down to about 100 very high conviction names that we like to own. So go to the next slide. Now, I don't want to spend too much time on here, but just gives a little bit more detail on how those scores in that table on the right are calculated. But the main gist is the higher the active weight in a underlying source manager, the higher our alpha score is going to be. So can we go to the next one, please? Okay, so once we have that, how do we build our portfolios? Well, what we really want to make sure that we have a certain risk awareness to our portfolios. And so some of the things that we implement are active bet guardrails on individual names. So for instance, in our core portfolio, which is benchmarked to the S&P 500, we will not start an initial active bet greater than 2.5%, either on the positive side or on the negative side. We do allow that weight to drift as the security continues to work. So if we start at an initial position at 2.5%, we'll ride that all the way up to 3 until we do some risk management and bring that back down. The other thing that I mentioned earlier is that we really have great stock pickers here, but one of the things that we've seen over the tenure of portfolio managers here, we also do a pretty good job, and I want to thank Denise a lot for this, is in our sector tilts and our sector positioning. And so what we want these portfolios to do is also reflect the sector positioning that our portfolio managers have. So actually our guardrails from a sector basis aren't against our product benchmark. They're actually measured against the average of our underlying source managers. The other thing, without getting into anything too technical, we do have a risk model which really shows types of style exposures you have, whether it's momentum, whether it's valuation, whether it's growth, volatility, etc. And just similar to the sectors, what we want to do is mimic those characteristics of our underlying portfolio managers. The other last few things that we do is we make sure that we're in heavily, very liquid securities, and our turnover is going to be less than 50% a year. And we do want to make sure that we are in that same category as our benchmark. So if you're going to buy our large cap value fund, which is benchmarked to the Russell 1000 value, we want to make sure that we're in the same category as our index. And so can we go to the next slide, please? And so here what we're showing is just the lineup that we have. So we do have 4 products. We have 3 large cap products. These launched, we have two strategies, the core and the growth, which were existing strategies. We converted to this type of an approach at the end of February. And we launched the large cap value from brand new at the end of February. On the very right-hand side, we've had one of the reasons we actually went down this path to create these large cap products is we've had a small mid cap product, FFSM, in existence for over 3 years with a very similar methodology with a multi-source approach. We've had tremendous success in that from an investment standpoint. So it really led the effort to expand that approach into the large cap space. And the 3 large cap funds are all fully transparent. So you can see the daily holdings every single day. The mid cap one is semi-transparent, so we don't disclose daily holdings, but we do on a quarterly basis. And so with that, I'm hoping that I gave you a pretty decent overview, and it's really a team approach. We don't have any real single manager risk as well with this type of a product, given the multi-source nature of it. We're going to maintain style consistent with, some very strong risk management, and just the vehicle itself of the ATF helps from a tax efficiency standpoint. So I think there are a lot of benefits for this lineup, and hopefully you'll consider using these as a way to kind of capture that investment expertise that we have at Fidelity across not just our portfolio managers, but analysts and strategists and quants as well. And so thank you for your time. So I will send it back to Mo.
Thank you both. Wonderful presentation. Very, very smart people in our company. All right, so ready for some Q&A? All right, so the first question is going to go to you, Denise.
Yeah.
What's the outlook for Europe?
For Europe? Is that what you said?
Yeah.
Yeah, so look, I mean, there's absolute and there's relative. I think that all global equities look positive to me, both from, a growth perspective and an earnings growth perspective and monetary policy accommodation perspective. So I don't think that, from the base case perspective, I'm not saying that Europe would go into recession, but back to that sort of relative valuation gap and what's been a consistent driver of outperformance of Europe versus the US, I think it lags. So we have seen structurally the US on average grows GDP about 3% and Europe grows GDP about 2%. So that compounded growth has A, stayed the same through time, and B, still favors the US. So I don't think that necessarily Europe is falling off a cliff, but I don't think it's likely to keep up with the US from an economic standpoint. And then it is even worse, I think this is the bigger issue, from an earnings growth perspective. Not only is technology just dominant in the US, and that's really been the driver of earnings growth, right? So it's easy to come up with an index that says, well, the S&P just grows earnings faster than EFA or Europe does. And that's very clear. And it grows faster and faster over time. But that's partly because of just a skew towards technology stocks. If you unskew it and sort of look at the sector neutral-ish company in Europe versus the sector neutral-ish company in the US just grows earnings faster. So over time, the market just rewards that. So that's why value, yes, there is value on your side in Europe, but more often than not, the headwind that you will receive from the lagging earnings growth of owning European stocks offsets any boost you get from relative valuation. That's why I think Europe is still a negative risk reward from an equity market perspective. I'll add one final point. I do think over the long term, and this is more opinion, so I always say, you'll never hear me state my opinions, you'll just hear me state the data, probabilities associated with the data, and how you can use those probabilities to turn them into your own investment portfolio. I'll give you a slight opinion that's less based on the data, but I do think that the next cycle will be defined by monetary policy in the sense of there will not be fiscal support to have. So you are left with monetary policy cushioning whatever blow comes. I don't know when it's going to come. I don't know when the next cycle is going to hit. But to the economy that has had the Federal Reserve or that has had the central bank allowed to hike interest rates enough, they will have enough bullets in the gun to cushion the impact of any economic blows. Again, that's the US over Europe, right? So Europe never was able to hike rates nearly as much as the Federal Reserve was. Why? Because their growth wasn't strong enough. And you see that in their lower levels of inflation. So I think it's check, check, check across the board that favors the US over Europe.
Thank you for that. Derek asks, growth stocks have outperformed all other asset categories for the last 10 years by a significant margin. What do you expect in the future?
Yeah, so I think it depends on your time frame and it depends on your index level. So that's true, although within that 10-year time frame, ironically, we saw the best 2-year value rally we have ever seen from my perspective as an equity market investor. I can't remember, Tim's a value guy. Tim knows what years they were probably better than me. I think it was 2022, 2023. But we did see a massive value rotation in that. So I'm not saying that that will be the same thing, but I do think that the risk reward is more neutral for large cap growth equities relative to value. As you go down the cap spectrum, I actually get much more interested in value over growth. So it goes from neutral to a clear small cap value bias over small cap growth. And I think that that's all around the discounting mechanism in the market, wide valuation spreads, which were the expression of fear, and the relative valuation gap relative to the fundamentals. So you're really seeing that really wide pull of a rubber band down the cap spectrum relative to the like R1G, R1V. So that differentiation isn't nearly as sort of onerous. Like I think growth is neutral-ish, but it's not negative. I think that value skews much more favorable to me when you go to an equal weighted index, and then when you go to a mid cap weighted index, and then when you go to a small cap index.
Thank you for that. Jim wants to know, what's the benefit of the fundamental investment process?
Yep, I'm happy to take that. So the multi-source aspect, one of the things I think is very beneficial. One, you get insights that aren't necessarily able to be arbitraged away in a quantitative framework. So I am a quant by nature. So I am, very, keen on investing in different types of factors like valuation, growth, revisions, and blending them in certain ways. But one of the things about, I think, the value of fundamental investing is the ability to really dig deep, as opposed to a quant who puts a lot of emphasis on breadth. So they don't get very deep into actual analysis on any particular company. But we have the capabilities here at Fidelity to do that. And you really can get some unique investment insights by going down the fundamental path and digging deep. One of the other benefits, I think, of our multi-source approach, say, as opposed to just a fund of funds, you could go out and buy, 5 different large cap growth funds. But one of the things would happen, I think it'd be very difficult to outperform because you'd be so overly diversified. One of the things we really try to do here, like I had mentioned earlier, is find the highest conviction ideas in which to invest and be different from the index in those names. And so we may be sourcing ideas from several different managers, but we are having a much more concentrated portfolio than you might get from a fund of funds approach in any one particular investment mandate. And so I think those two aspects, it's the deep research as well as more concentration in the products that we're now offering on the fundamental active suite, I think are the two of the main attractive parts of that process.
Thank you for that, Tim. This is like our number one voted for question. And, we've talked a little bit about small cap, large cap, but will small cap continue to do well?
It depends on what you mean continue. You mean the last 10 days? Because up until the last 10 days, it's been underperforming by about 1,000 basis points over the course of the next year. So look, despite that underperformance that we've seen, I am very favorable on small caps. Depending on your risk tolerance, if your risk tolerance is not that high, maybe an equal weighted index. If it's a little bit higher, maybe a mid cap index, since they have, a lower percentage of non-earners. And then if your risk tolerance is quite high, maybe a small cap index, or even the small cap fund that Tim was talking about earlier. So I'll tell you why. So it's not just that the Federal Reserve is cutting rates, which usually is good for either equal weighted or lower down the cap spectrum. And it's not just the momentum we've seen, when I look at the momentum that we've seen, it's not particularly predictive, but it's about that coiled spring that I have seen in my work. So small caps, the valuation dispersion is the widest there. The wide valuation dispersion, again, is that expression of fear. When investors sell anything they think is risky, they buy anything they think is safe. That valuation gap, is different every cycle in terms of the names that are in it, but it usually means that the market has discounted something that even if it comes to pass, the second derivative is positive, and you can use it as an alpha signal. So the wider valuation spreads are, the more likely small caps, mid caps are to outperform their large cap peers. That is where we stand today. At the same time, that relative valuation finally drifted into the top quartile on my indicators, right? So now again, back to that rubber band stretching, right? So it's been wrong to be overweight small or mid caps as the rubber band has stretched, meaning they've gotten cheaper relative to large caps. But given where we are today, large caps top quartile expensive relative to small caps, you see a very monotonic relationship that you want to lean towards those equal weighted mid cap and small cap indices. And what's more, is that when the Federal Reserve is cutting from that position, you see a very outsized amount of multiple appreciation, not necessarily earnings growth, just that the market pays you differently for the earnings growth that you already have historically. That's why I think if small caps, I do think it's a positive risk reward. If they outperform, it's very likely to be a pain trade because fundamentals aren't necessarily going to improve when interest rates go down, but valuation does. To give you a data point, over the last 20 years since 2000, when the Federal Reserve has been cutting rates and the stocks, large cap stocks are expensive, even in the top half of the distribution, the relative multiple difference between equal weighted stocks and cap weighted stocks has been 20 percentage points. That's the difference in terms of what you get from multiple expansion, which is a lot to offset whatever lagging earnings growth you might get. So look, that was a long-winded way of saying the backdrop is now positive with, I think, that the Federal Reserve cutting interest rates, but earnings growth still accelerating. So check that box. We have a coiled rubber band that is potential for an upside melt up, given the fact that you have very wide valuation spreads and a very good valuation starting point. And you couple that with the fact that what's been different this time has been the very quickest I've ever seen acceleration in technology earnings from bottom quartile to top decile. Now that we are at top decile, it's going to get easier for other areas of the market to start that relative earnings growth inflection, which has been very delayed this cycle. So I don't think it's interest rates that are necessarily the catalyst. I actually think it's technology growing earnings at basically one of the fastest clips it's ever grown as offering the potential for the market to broaden out to small and mid and equal weighted stocks.
Denise, Tim, we're at time. Thank you both for a wonderful educational hour. And thanks to all of you for joining today. We know your time is very valuable. Make sure you let us know your thoughts on the webinar in the Q&A tool. As a reminder, we have a number of other great webinars like this one coming up, and you can find them at www.fidelity.com/webinars. We look forward to seeing you again. Until then, stay safe.